Hi, today's video will be about the criteria to consider for picking stocks. These are my preferred metrics and represent my opinion only. So I hope that you find information useful, and if you like the channel, please press the subscribe button. To analyze stocks, you have two major methods. The first one is fundamental analysis, and the second one is technical analysis. Fundamental analysis is about analyzing the financial health and performance of a company, whereas technical analysis is analyzing market data to identify trends and patterns. In this video, I will be focusing on fundamental analysis. That's typically the more important method for long-term investors. At this point, I assume that you know what stocks are, so let's just go straight in. The first metric is earning per share. This measures the amount of profit that a company has generated for each outstanding shares of common stock. If two companies are identical in every way, then the one with the higher EPS would be preferable.
So let's have a closer look at earning per share. Let's assume we have company A and company B. Let's say that company A has earnings of $100 million and it has 50 million shares outstanding. So that's an EPS of $2 per share. It earns 100 million and has 50 million shares. Now, company B also has earnings of 100 million, but it has 200 million shares outstanding. That means that the earnings are spread amongst a wide number of shares. So that means that the EPS here is 50 cents per share. Now, for that to be meaningful, you really need to compare it to the share price. So let's have a closer look. Let's say that now you have an EPS of $2 and you have two scenarios. Company A, the share price is $6. That means that when you buy the share, you pay $6 and you earn $2 a year. On the other hand, if the share price is $200, that means that you're paying $200 for the privilege of earning $2 a year. So one clearly feels much better value than the other.
The price to earning ratio. This metric measures the amount of earnings compared to the share price. So essentially, this ratio does what we just described in the previous section. A high PE ratio can be indicative of a stock that is overvalued, whereas a low PE ratio can be indicative of a stock that's undervalued. So if we take the example we just used,
So let's say that we have the share price at $6 and the EPS at $2. Now, to calculate the PE, you divide the share price by the EPS. So that's a PE of 3. A PE of 3 means that the current share price is equivalent to paying 3 years of current earnings. If nothing changes, you have repaid your investment within 3 years. Now, if the share price is $200, the PE ratio will be 100. Now, a PE of 100 means that you are paying the equivalent of 100 years of current earnings. So if nothing changes, it will take 100 years to recoup your money.
on the face of it, if all else is equal between two companies, then the one trading at a lower PE ratio would be preferable. The valuation would be cheaper. There can be reasons why a company might trade at a very low or a very high PE ratio. So let's look at some of the examples.
So a stock could have a low PE ratio simply because it is overlooked by investors. Maybe it is in an industry that's a bit out of fashion and that's boring, but that doesn't necessarily mean that the business is not good. And so these occasions can present good opportunity for an investor because the valuations tend to be on the cheap. On the other hand, a low PE ratio can also indicate difficulties with the company. For example, it might be that investors expect the business not to be able to sustain its current earnings. There might also be perhaps a lot of debt that put pressure on the earnings, or there could be competitors or new product that is rapidly taking business away. And so today's earnings might not be representative of what the earnings will be next year or the following year. So if you imagine, for example, the profits for a local grocery shop, and next year a large supermarket opens next door, then those profits will drop very suddenly. So that's the type of situation that can justify a low PE.
A high PE ratio can indicate that a stock is popular with investors. Sometimes that popularity can be misguided and the valuation go beyond reason. For example, during the internet bubble, many stocks that were linked to internet were displaying valuation that were far too high. However, a high PE ratio uh, can also indicate that investors expect earnings to grow quickly over time. So if you think, for example, of a startup, um, in year one, they may have losses or a tiny profit. But if their product is gaining popularity every month, you might expect that their profit in 5 years' time would be dramatically different than what it is today. And in that case, a high PE ratio might be justified because you're essentially betting on the future earnings of a company. So think, for example, like a Facebook, when it was a 1-year-old company versus when it was a 10-year-old company, the revenue and profit have changed dramatically. And so a high PE ratio is simply betting on the future earnings of a company. Now, that might be the right or the wrong bet, but that's if you were to boil it down to just a single line, then that's what you're doing. You're betting on the future earnings of a company. The price to book ratio is useful in comparing a company's value versus its book value. The book value is the value of its assets as recorded on its financial statement minus its liabilities.
So let's say that we have a company that has only one asset, and that asset is a building that's worth $5 million. Now, if they have against that debt of $2 million, then the book value will simply be the difference. It would be $3 million. Now, if the company's valuation, if its market cap is, let's say, $1 million, then the price to book is 0.33. So here in this example, it is less than 1. That means that you could buy the company for less than the value of its assets. So that would be a deep value play. On the other hand, if the company's valuation is $9 million, then the price to book is 3. That means that the company is valued at 3 times its book value.
Generally, a low price to book ratio is indicative of a company that could be undervalued. If two companies are very similar, have the same earning prospects, similar profitability, then the company that has a lower price to book ratio might be more attractive. Um, the price to book ratio, however, is better suited for industries where there is a lot of capital requirement. Um, because, for example, industries that have a lot of intangibles, such as technology companies, might have a very little book value. So that ratio might be a bit misleading. If you think, for example, of Microsoft, they may not have a huge amount of assets invested in capital because most of their value is in intellectual property. And that's not necessarily part of the book value. The price to sales ratio. That measures the price of a share versus the revenue that the company generates. Typically, a lower price to sales ratio means that a company might be more undervalued, whilst a higher price to sales ratio might mean that a company is more overvalued. However, this only looks at the sales element, and you need to consider the profit. So look at the profit margin, because a company that has 1 million revenue but has 80% of profit margin might be more attractive perhaps than a company that has 5 million revenue but only 5% profit margin. The debt to equity ratio. This measures the amount of debt compared to the equity of a company. A high ratio might indicate that a company is taking on too much debt. Uh, think of it the same way you would think in your personal finance. Having no debt can be good. Having a little debt is okay, but having a lot of debt might put too much pressure on your earnings. So it's the same with a company.
Some industries have higher natural level of debt. For example, utilities companies tend to have high debt because of all the required infrastructure investments. On the bright side, their revenue tend to grow steadily without too much surprises. So in this instance, the debt is manageable. On the other hand, a fashion company with a high level of debt could be in trouble quickly if its products fall a bit out of fashion.
Again, if you draw a parallel with personal finance, if you have two individuals um, earning the same salary, but one of those individuals is, say, a civil servant with a low risk of being fired, and the other one um, has the same salary but in a job that has a higher risk of getting fired, then these two individuals won't be able to take the same level of debt simply because one has a more stable profile. That person would be able to take more debt than the one who is more at risk. The dividend yield. This measures the amount of dividend paid for each share. A high dividend yield can be attractive for investors looking for income. However, you need to consider whether the dividend is sustainable for the company. That means whether the company will be able to keep paying that dividend over the years. You can also look at the history of dividends. Some companies have been paying dividends for decades and decades. So that's an indication of management's commitment to pay dividends to shareholders, but also maybe the resilience of the company to go through various business cycle and still be able to pay that dividend. Another important factor to consider are industry trends. Some industry that are trending and have a lot of momentum for them might provide better earning and profit prospect for companies within that sector. And the companies within that sector might passively benefit from that overall wave of demand. If, for example, you look at electric vehicles and electric bikes, there are a lot in the news, and more people are buying those. One of the big components are batteries. So, battery manufacturers might passively benefit from that overall momentum, from that big wave of demand within the sector. And that's regardless of them doing any advertising or anything. It's just that their industries is in a good, strong cycle. So they just benefit passively from that. And so that's the sort of thought that you should consider as well in your investment process. You can also think about the characteristic of an industry. So, for example, some industries might be capital intensive. They require a lot of investment, a lot of capital expenditures. Think about a power plant or other infrastructure companies. Whereas, say, a technology company might not require as much capital. So, these can have different impacts in terms of profit margins and amount of debts and stability of a company. Um, Likewise, some industries might have more cyclicality and seasonality. So the earnings might go up and down depending on cycles or the season. So, in terms of seasonality, if you think about the food industry, um, cereals, you might buy that all year round. But ice cream, you buy it more perhaps in the summer. So that's seasonality. For the cyclicality, some industries might not be doing well when there is an economic downturn. So people, for example, might spend less on going out to restaurants or staying in hotels. But when the economy is booming, people might have more demand for those. And so that's the cyclicality. So you'll have waves of up and downs in earning, and some other industry, for example, an electricity company, might have a more stable earning. Finally, do not discard your personal experience in daily life. You might notice that some product or services are getting more popular. For example, you might see them advertised a lot. You might see people using these products. Your friends start to talk about it. Perhaps you use some of those products yourselves. So this could give you a clue that perhaps there is an opportunity within that sector, and you could look at companies within this field. So now you've narrowed down maybe an industry, a sector. You compared various metrics and ratio, and you've come up with a company that you want to look more into. So at this point, you need to look further into the performance of that company, look into their financial statements. Some of the elements to look at are often financial statements are filled with numerous amount of accounting adjustments and stuff like that. That can make it really hard to properly assess the performance of a company. And you may have company A and B that have very similar businesses, but comparing the two might be difficult simply because of various accounting choices that are made by each company. For example, you might have company A that have a 20% jump in profit. But that 20% jump in profit might be simply due because of a change in accounting valuation methodology for some assets or for some contracts, rather than an increase in sales. Likewise, you might have the management of a company that are blaming extraordinary items for poor performance. So, for example, extraordinary items are items that are not part of the regular business. You may have, for example, restructuring costs, and these can be extraordinary, that they happen in that 1 year and that's it. But you may also see that some companies seem to have extraordinary items coming in the earnings every year. Um, so one way that I deal with those is that I look at 3 year averages when I look at various metrics.
So, for example, if I wanted to check the earnings growth over a period of 10 years, I would take the most recent 3 years average earnings and I would look at the average earnings of a 3 year periods 10 years ago. And this can help if the company has volatile earnings, then this can smooth a bit and give you more of the average picture of the company, because it may be that, I don't know, the year 2023 or the year 2013 was really good or really bad, but might not be reflective of the company's normal performance. So averaging the calculation helps smooth out the data a little bit.
And if you're looking for income, don't forget to look at the dividend and the dividend history. As mentioned earlier, it's good to assess whether the dividend is sustainable for the company. So now that we had a look at broad financial elements for the company, it's also good to consider qualitative elements. Those qualitative elements include things like the management team, the product and the services, the competitors, and the overall growth prospect of the company.
With the management team, you can check if the team has been stable or if there's been a lot of turnover in the board and the senior management. You can also read the CEO letter from a few years ago and see if the CEO delivered on what was said in the letter, and if not, what was the justification. So you can compare the financial statements from 3 or 5 years ago and see how they executed the plan. Likewise, it's also good to see that the management has shares in the company, that they have their own money, their own skin in the game, so that their interest is aligned with shareholder interests. A management team that buy a lot of shares might be a sign that they have a lot of confidence in the company. Likewise, a management team that sell a lot of the shares might be a sign that they don't have much confidence in the company. So you can check the dealing of the senior management team.
In a previous section, we discussed industry trends. So now you should consider how this specific company sits within its industry. Is it a leader or is it a new joiner? What are the advantages of its product and services? What can the company do to protect its profit? You should think about things that will help the company keep its competitive advantage and maintain its earnings. So that's the moat of the company. Um, for example, in some industries, you might simply have capital requirements that are so high that it's very difficult for new entrants to come in, or you might have very big regulatory hurdles, and so that helps existing companies maintain their market share. You may also have companies that have a very strong brand and a loyal following, and that helps them keep competitors at bay. You may also have companies that have strong portfolio of intellectual properties, which make it harder for competitors to take their market share. And again, don't underestimate your personal experience. If you suddenly stop using product and services and start moving to a new platform, then this might perhaps be a clue uh, as to a changing landscape within a specific sector. As a random example, there is a specialist retail chain that I like to shop with. And when I look for items within that sector, if they sell that item and even if the price is a bit higher, I will usually go and buy it from them. And the reason for that is quite simple: is they have a very long no quibble return policy, so that if a year down the line, for whatever reason, you've changed your mind, you're not satisfied with the product, you just bring it back and they give you your money back, and that's it. And to me, that's great customer service. That makes me confident to buy from them. And that's subtle elements like that that might just guide you towards one share versus another, in terms of that's the perception that the customers have, and if it attracts you and your friends, it might perhaps attract other customers. I hope that you found the video useful. um, I mean, we could go on at length and discuss more and more elements for selecting stocks. There's such an infinite number of ways to look at stocks, but hopefully this provides a good overview and ideas of how to think about stock selection. I hope that you enjoyed the video. And again, if you like my channel, please don't hesitate to subscribe. Thank you.